When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current event headlines, also top retirement concerns being discussed online. We'll answer listener questions, and then finally, the Premier Retirement Roadmap, what that is and how it can help you. My name's Jeff Shea. As always, just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. How are you doing?
I'm doing great, thank you. Always appreciate you being with us here. We're in the middle of December. Santa Claus is coming to town here in just about 12 days or so. So, Jeff, I have heard about this Santa Claus rally. What exactly is that, and are we expecting it this year?
Well, I think every year it kind of happens. I remember the one that everybody thought we were going to miss was back in 2018 when we had this year-end sell-off in December. The market went down 20 or 25%. And then, sure enough, it just roared back, and the first of the year was good, too. It's a typical thing for what I call window dressing. It's a Santa Claus rally, but it really is just a bunch of fund managers and hedge fund guys and anybody that wants to show that they had a good year tries to buy. Sometimes even market makers will manipulate, and I say that not loosely. I mean, that's just what they do is they manipulate the market by buying, doing stock. Some companies do stock buybacks to make their stock look good by the year end. So there's a lot of what we call window dressing, not necessarily fundamentally based, but just trying to get more buys and sells. Rate decreases here and there, they typically indicate recession. The market doesn't seem to give a hoot what Powell does at one time or another. They pretend to care, and then the market just forgets about it in 2 days. So I don't know that we have any indication, even if there is somewhat of a hawkish view forward with possible rate decreases. But the bottom line is if there's more buyers and sellers, the market goes up. If there's more sellers and buyers, the market goes down. And the market makers are in control of that to a very large degree, as long as the Fed keeps giving them money, and they keep doing that by buying their debt. The banks are supposed to buy it back. In other words, the Fed gives the banks a lot of money. The banks are essentially the brokers, the market makers, the inventory keepers of the stock market. So if the Fed, who, by the way, has been doing QE for the last several months, not QT like they did just for a minute during 2022 and 23, when inflation got out of control and Bidenomics took a grip on the economy and started making everything go crazy. So they had to tighten the economy by raising interest rates. But on the side, they've been handing banks money by buying their bad debt, things that are considered unrealized losses, debt that is being written off but isn't being written off. It doesn't have to show up on their books as bad debt. They just hand it over to the Fed and say, hey, hold that for us. Just loan us some cash. We'll buy it back later. Well, they never end up buying it back later. They end up just spending that money and they buy stock, which is, if you look at the money supply, you look at what the Fed has been doing for the last 10 or 15 years, there's a very strong correlation with how much money is being basically printed for the bank so that they can buy their own stock. They can loan money cheaply to their crony customers, which they try to allow to do everything from stock buybacks and manipulate the bid and the ask prices on stock a lot of times. So for a long time, we haven't really had a true market force-driven market. It's funny they call it the stock market. It totally isn't the market. It's a stock, whatever they decide it is. And the thing is, they can play games with us both ways. They can continue to make the market go up pretty much at will, unless there's some huge piece of news that scares the average investor. And right now, 65% of households own stock, which means there's more Main Street people owning stock than ever before, which is considered the less smart money. Some people call it dumb money. I don't want to disrespect the Main Street investor because many of them do a little bit of research and try to figure out what's going on. But bottom line is they have more emotion probably than the market itself. And so the market makers are in a position to kind of manipulate Main Street to a certain degree. And I think every year end, they try to do that anyway. So to answer your question, will we have a Santa Claus rally? I expect not to be running for cover, even though I think the market's overvalued and I think we're due for a crash, and I have for a long time. Doesn't mean we're not still trying to make money and follow the money for those investors that want to take risk or have at least on portion of their investments and aggressive profile. So, I mean, we're still taking advantage of the upside of the market, and we don't mind if it's manipulated, but we can also see when things are in an uptrend, downtrend, sideways trend, or when there's more sellers coming in, when there's more insiders, meaning CEOs and the upper level management, board of directors, people like that, more often selling than buying. And right now, it's hard to find any stock that has any buyers of their own stock. It's hard to find any company whose insiders, in other words, whose C-level, management level, or directors are buying. Almost none are. It's very few and far between. And most of those are like small cap startup companies where they're buying cheap, or they're buying on or converting warrants or something like that, or options. So, yeah, the market's obviously not as healthy as it seems based on the buying and the manipulation. But as long as the Fed keeps playing games with banks, the banks are in control. And I'm sure they're going to make us have a market rally. I mean, the banks aren't able to loan out money. I mean, shoot, look at housing. It's down. That's a big part of the banking economy, right? Is lending money on mortgages. Mortgage rates are so high, nobody wants to borrow. The disparity between sellers and buyers in this market, it hasn't been this bad since I think the 70s or something. Maybe it was the 80s, whatever. It was a bad market, far more sellers than buyers in the market. And that doesn't look good for banks. Car dealers are giving away money and trying to supplement financing in order to get you to buy a car. I don't know what we're going to see as far as a year in the auto sales industry. But again, if banks aren't lending money, then how is Goldman Sachs and Citibank and Bank of America stocks making all-time highs and they're showing all these profits? Well, it's because they don't have to show losses on their financial statements as long as they're loaning their bad debt and the things that are actually money losers to the Fed for actual money that they can invest in their own stock and other stocks. So again, it's just the state of the affairs of the economy and of the markets. They're getting, in my opinion, more and more manipulated, more and more corrupt. But we're seeing that in politics. We're seeing that in business. We're seeing that just about across the board. It is what it is. And I'm not being a doom and gloomer. I'm just an observer. We're in a world that has different forces driving the markets than fundamentals that used to drive it when I first started in this business, when I first became a stockbroker and could actually look at price earnings ratios, look at earnings growth, look at economic situations and make a decision on what stocks made sense to buy. That was a long, long time ago. Anymore, there's a lot of hype on the AI industry and the tech industry. And, you know, in a large part, those are going strong because I think more hype than anything because they're overvalued if you look at conventional numbers. And you're also estimating that this AI business is so many trillions big and that somehow every single company is going to end up having all of that market share. Well, it's going to be shared. There's going to be a few big companies that emerge like the big Magnificent Seven did after the dot-com era. There's 7 or 8 big companies that dominate. By the way, if you look at the trends, even though the market seems to be making new highs regularly or flirting with the new high, if you're looking at the Mag 7, the biggest 7 stocks that basically drive the entire S&P 500, 4 of them are in a downtrend, are a legitimate downtrend, more selling than buying. When they say buy the dips, well, if it's a downtrend, you're not buying a dip, you're buying into a downtrend. That's dangerous. So we're seeing some things that aren't being reported very accurately, I think, from the market. We've got a couple of them that are still kind of in an uptrend, but kind of flattening out. In other words, we're looking like we might be running out of gas. So I think if there is a Santa Claus rally, it might be kind of the last injection of fuel into this fire. And maybe first quarter, second quarter next year, we're going to see what I've been talking about for the last 2 years. And that is got to be a day of reckoning coming eventually. And I think the only thing that's been putting it off is the Fed has been able to play games with the way they treat these funds for banks and basically continue to quantitative ease, even though Trump says we have to ease and lower interest rates. It's probably not the best thing for the economy to do, but it's the best thing for us as a nation to do in order to service our debt at lower rates. And unfortunately, the only thing that Fed can do is lower the short-term rate. And so all we can do to refinance the debt is refinance it at short-term rates, meaning it has to continue to refinance. The long-term notes, shoot, I just read an article that said that the 30-year Treasury will probably hit 7% sometime in the near future. Well, that doesn't bode well for trying to refinance debt and lock it in on a long-term basis. It'd be foolish to do that. So hopefully the short-term interest rates can at least get us by for a while. But what we have to do is quit growing the debt. And by printing money, we're growing the debt. And they're just continuing to throw more fuel on this fire. And I don't know when it's going to, light the world on fire. But man, this market's going crazy. So I don't know. We'll probably have a Santa Claus rally. But anytime you invest in the market, be careful. Only invest money you can afford to lose, even if it is a consistent thing that happens near the end of the year. The last week or so is typically the best upside that we get in the market. But then again, we've still got all these discussions about the Fed meeting this past week and the future rate hikes. Are they going to happen? How is it going to direct the economy? And honestly, the market doesn't seem to care. So jump in if you have the guts and the stomach for it. If you don't, the nice thing is interest rates are still high enough to make reasonable rates of return on safe money, which currently beats the inflation levels, which have been tamed at least under the 3% level. The producer price index and most of the PI, CPIs and all those inflation numbers seem to be coming in under 3. It's not the 2 that we were hoping for, but under 3 is still manageable, a lot more manageable than, say, a 9 or 10% rate of inflation like we had a few years ago. So that's kind of my take on the Santa Claus rally. Always, when you're playing with the market and you're playing with history, the history might be on your side, but the market is still the market, and it can still bite you in the you-know-where if you're not careful.
Talking with Jeff Oken of Premier Retirement, and we're talking about the state of the economy right now. These are current events headlines, and once again, if you'd like to be in touch with Jeff, our phone number here, 520-780-9059, 520-780-9059. If you'd like to come and sit down with Jeff, talk about your individual situation, and really just take a look whether or not your portfolio is prepared for times like these. Jeff, corporate giants like Amazon, UPS, Target, each announced layoffs in the last couple of weeks here. 60,000 jobs cut this year. Some of the companies are investing in artificial intelligence. They're looking to cut costs elsewhere, and the layoffs are likely concerns about the economy and a slowdown in consumer spending. According to some experts, what do you make of these layoffs, and is AI really to blame for these?
I think AI might be to blame for some of them in the beginning, but I think just a sluggish economy is most to blame. You know, people aren't able to borrow money and buy things anymore. The consumer discretionary spending is down. Jobs are down because companies can't afford to hire them because their profit line is getting squeezed out. A little bit of that we might attribute to the import fees, the tariffs that have been imposed. That's always going to pass on to the consumer one way or the other. Companies are having to be a little tighter with their budget. And if they're not selling what they're producing, then they need to decrease their employment. And as you do that, it's going to always put a little bit more to the bottom line, which might be another way to prop up the stock market for a little while longer. But eventually there's going to be those households that are no longer working that own stocks are going to sell the stocks. They're going to have to sell investments or not invest continually in their 401ks. They won't get the company match maybe. And there's going to be a lot of money not going into the market because of those people that aren't working, because those people that are laid off aren't contributing their 401ks anymore. In fact, they might even be selling, like I said, selling their stocks and some of their individual investments to live, or even borrowing from their 401k, which also causes those positions to sell out of that account in order to give you the cash to live on and to make it through a tough time. But as far as AI costing the jobs, I think we can blame AI if we want to, but I think AI, because of the economic increases, and I was at a seminar in San Diego last week that was very interesting, as a few speakers talked about the future and the take on AI and everything from aging to medical advances to all the things that AI can do in the next 5 years, the things that we're going to have automatically done. It doesn't necessarily make us all zombies. We just have to sit around and watch all these robots do all the work. Or does it actually create more time when entrepreneurs will have new ideas, new businesses, do new things, maybe more ways to have recreation because you have more time in your hands because computers do so much of your work and you don't have to work as often to do the same type of things. You know, maybe the financial world will be totally automated out because an AI investment manager is easier to work with than sitting across the table and getting the warm fuzzies from your financial advisor. You know, maybe I have to worry about that. But if that's the case, then there will be other doors open. And as the AI increases the economics, it's not just going to be a few billionaires getting to be trillionaires and hoarding all the capital and doing nothing. I mean, the fact is the world of people still have to drive it. I mean, who's going to buy the AI services? We have to generate cash or economics somehow, right? What are the billionaires just going to pay half their money to the government for the taxes and then they just take care of us like little sheep and we just follow and do whatever they say? Maybe that's the goal for the government. I hope it isn't the outcome for the real economics of our country, especially. But the premise of this whole talk was don't be scared of AI. There might be a temporary setback in employment as people's jobs are displaced, but they are displaced, not replaced or not gone. They just will have new skill sets, new opportunities. With all the extra time and assets and economics that are generated by AI, more economy will come to be. And so that'll present opportunities for different type of maybe college education, trade school education, skill sets that we need to develop in order to do more things that we don't even know will exist.
Jeff, just a few more days here left for this year, actually probably about 17 or so. If you had to give practical advice, next steps, something that retirees and pre-retirees can act on this week, what would you recommend?
Well, I definitely say get a tax review. Make sure that you're maximizing your present tax bracket, especially if you're concerned about rolling money into Roth IRAs or planning for the future, we want to make sure that in the future, when we think taxes will probably be higher than they are now, you should pay taxes on the least amount of money at the lowest tax bracket possible. Now, that might be after you work. It might be before you work. But I think a tax review before the year end is pretty smart. There's opportunities to do charitable gifting. There's opportunities to do even donor advised funds where if you don't have a charity that you want to give money to, but you know you will over time, you can actually upfront fund that charity and offset maybe some deductions for a big windfall income year. You might want to change your allocation of your 401k to Roth in order to pay taxes now if you're in a decent tax bracket with some tax deductions that you can get while you're working that you might not be able to receive when you're retired. You might want to talk or look at just the type of deductions that you can get. Also do some tax loss harvesting. That's another thing to do at the end of the year, meaning if you have some dog positions in the market that you might want to sell, or you might want to say, well, gosh, I'd really like to take profits on some of my NVIDIA stock, but man, my taxes are so high. And then you've got this other stock that's down 20%. Well, sell the one that's down 20% that looks like a dog, that looks like it's kind of run its course and isn't going up for a while, and let it offset those capital gains on the stocks that you sell at a profit. So the thing that so many people do is they acquire all this wealth by sitting on things and just deferring the tax consequences, kicking the can down the road, that it ends up coming back and hurting them in the long run. I don't think there's necessarily, I'm not saying the buy and hold strategy doesn't work. It does over decades. If you buy the right stocks, if you just stick it in the market, close your eyes, just set it and forget it. But if you're trying to actively manage your assets, there's no reason you need to ride a stock all the way back down to where it came from. You never get hurt taking profits. And it's smart to take profits along the way. The thing is some people are so scared by the taxes, they want to kick them down the road, that they don't take advantage of not only taking profits, because you always make money when you take profits, paying those taxes and then resetting your basis so that the gains in the future aren't going to be as high. So you pay taxes along the way rather than taxes one big time when you decide to pull a few $100,000 out of that investment account to go buy a cabin for retirement up in the mountains, or to get that super cool $1 million motorhome you want to tour the country in or something like that. And you want to end up pulling $1.5 million out of your investments because they're almost a zero basis, and you end up having to pay taxes on the whole stupid thing. So again, tax planning is probably the biggest thing you need to do at the end of the year. Unfortunately, most CPAs like Christmas vacation. They're already burned out from all the extensions that lasted them through October. And most financial advisors are already swamped. So if you have an advisor, hopefully you've already got that appointment set. If you don't, I think you'd probably be hard pressed to get in here because we have so many clients that we're working with. But I would definitely take a review of your taxes and make sure you have some sort of a plan in place that will minimize your future tax problems, even by maybe making a small tax problem this year. You might feel like it is. But I think that's always the year-end focus that we have. It's always about tax. It's always about tax year-round, but this is the time that you have to make those last-minute maneuvers to make sure you do it right.
We're having a discussion with Jeff Hogan here of Premier Retirement Planning and Wealth Management in Tucson and Mesa. Once again, the telephone number is 520-780-9059 if you'd like to have a personal conversation with Jeff. Jeff, let's continue our conversation here. I was looking at some online concerns. There are a lot of top online concerns, and among them certainly would be healthcare costs, Social Security cuts, inflation, and taxes. You know, there's just the emotional concern about what's going to be happening with the world. But there is a number one concern that really trumps all the rest online insofar as that discussion goes. What is that?
Running out of money. That's definitely the thing. Most people are, am I going to be okay? What do you mean be okay? Am I going to be okay? I don't know. You're going to have good health? You're going to be okay because all your grandkids are going to move in and live close to you? Are you going to be okay because you never get sick? Or are you going to be okay because you're going to live to 100? No, it's not that. It's always, am I going to be okay? In other words, am I going to still have money no matter how long I live and be able to afford those things that I need, and maybe even get some sort of a buffer for a little bit extra fun and living life on my own terms. But it's definitely running out of money. And it's interesting, even very wealthy people, probably because they've never really worried about money, they've always made good income, they've always had extra. Now all of a sudden they're not working, making that several $100,000 a year or something like that. But by and large, those people in the higher income levels seem to be more worried about it, even though they've been better savers and they probably have less to worry about. The thing that I think really blows it up for most people is the fact that Wall Street and the industry wants everybody to keep their money in stocks and bonds. Now, we know just based on the last few years that bonds can crash 20%. Well, if you're using bond money to live on and the stock market is crashing too, which they can do at the same time, then you're spending money and locking in losses. And that's why even though the stock market averages 10% a year over the long haul, and bond market somewhere in the 4 or 5 range, probably at least, maybe even higher if you add some of those decades where interest rates was 18%, like back in 1981 and stuff like that. But bottom line is, why is there a 4% rule, which has actually been revised down to in the 2 or 3 range by 2 different credible industries? One is Schwab. The other one is Wade Pfau, who runs an Institute of Elder Income Studies or something like that. He actually has a designation that if you go to his school, it's called the Retirement Income Specialist designation. He says that based on, if we would have another decade or even 2 decades in retirement, like the lost decade of 2000 to 2010, that your actual rate of return in a stock and bond account, based on the volatility and based on the fact that there really was no gains over that whole decade, is that you'd run out of money in 25 or 30 years if you took out more than about it's under 2.5%. So if you use those rules of thumb, if you use that statistical research, which I believe numbers should prove everything. I mean, trust, but verify with the numbers. And if the numbers say even Wall Street's aggressive model, which was invented back in 1993 by a guy named William Bengen, he's a CFP that did some analytical analysis and figured out that 4% is probably the right amount that you can take out of a stock and bond portfolio, which averages over time 8%. Well, why is that? Well, it's because it factors in volatility. So if you're going to leave your assets in volatile accounts, just plan on taking out less than half of what their average rates of return are just to accommodate volatility. So the best thing people can do is get over that aversion that Wall Street tells you to have about annuities, life insurance products, insured accounts, and even fixed interest, even CDs right now. I've seen people that had CDs that never took market corrections up or down, made horrible interest, have their money last longer than people that were in the market riding the roller coaster ride for the last couple of decades. So the key to retirement and peace of mind or confident income in retirement, predictable income, even guaranteed income, is using principal protected insured accounts. Where can you get a principal protected insured account? I haven't seen one on Wall Street, meaning stocks and bonds. Now, Wall Street companies like Fidelity, they're selling annuities now. If you beg them for one, they'll give you a crappy one that you'll hate, so you'll never buy one again, to underscore their narrative that annuities are horrible. There's annuities that are real expensive and they will push on you. That's called a variable annuity. They typically have layers and layers of fees adding up to 4% or better in many cases. You only have a certain amount of choices that you can put your money into. And they'll either limit the risk to a certain degree to the downside, maybe limit the upside as well if you're going to limit the risk to the downside. But they don't guarantee any principal. They don't guarantee any return, and they have horrible guarantees if you ever use it for income. So I would stay away from variables. I'd basically stay away from any annuity you could buy at the brokerage houses because they'd rather track records in their history to keep you in the market because that's where the big fees and the money's being made. So like I say, I don't hate Wall Street. I use it for our risk money. We manage a lot of assets in Wall Street accounts, but those are the accounts that you don't need to live on, not the accounts that you need to live on and get monthly income from. So the biggest thing to do is make sure that you take your Social Security at the right time, maximize the benefits and the income from any pensions you might have. Make sure that if you have some indication that you might have a spouse that outlive you by a number of years, you might want to use a spousal continuation type of a plan, either with the pension itself or do an alternative so that you put money aside for the spouse if you decide to take the higher amount up front. And if you did meet your demise a little bit early and have to support a surviving spouse for a length of time, like decades maybe. So consider setting up your income first. And if you have, let's say, whatever you have, $1 million, $5 million, 500,000, whatever it is, let's say you take a third of it and you set it up for guaranteed income and your Social Security and your pension makes up 70,000. You want to get to 120 because you want 10,000 spendable a month that you can know you're going to have no matter what. Well, then we need to take enough assets out of that other portfolio or the balance of the portfolio and lock it in. We can do that through index annuities. I like index annuities with income riders because they are principal protected. The companies are able to pay more income for life. They're also very confident that they're not going to lose principal because of the way they invest your money, typically in very, very safe bonds. They're like investment grade bonds or government bonds. And then they take the interest that they make and they leverage that interest to make you more than you can make on your own, which is more than they could. They're probably going to need to pay you lifetime income. If they're wrong, they still pay you the income. If they're right, well, then there's going to be a balance left for your heirs, and they're going to make a few fees over time for a longer period of time. They're not going to have to cut into their own profits. So bottom line, if you divvy up your assets into categories that guarantee income and you can play with the rest and you only risk the amount you can afford to lose, you have some tax-free income availability, you can set yourself up to where you don't have to lose that confidence that you're going to run out of money or even have that feeling. You can feel confident in your retirement, retire on your terms and not drive yourself to worry during your retirement years.
Jeff, I'm sure that based on a conversation, our listeners may have some questions. If you want to be better prepared for your retirement future so you can have a better quality of life, you're looking to have a casual conversation to help you understand your options and what it takes to preserve your wealth or create income or reduce taxes, call us here and request your Premier Retirement Roadmap. Absolutely no cost and no obligation for this. Our number 520-780-9059, 520-780-9059. You can call this weekend if you'd like. Leave your name, telephone number. Shelley will call you back and set you up with an appointment with Jeff. Again, no cost, no obligation, 520-780-9059. We're also online at premret.com, premret.com. Jeff, time for a break. When we come back, we've got listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us each and every weekend here on 790 KNST for Premier Retirement. Again, we're on the air for you 4 times a week, Saturdays at 7 a.m., also 9 a.m., and you can hear us at 1 p.m. as well. We're also on the air at 11 a.m. And once again, if those times are not convenient for you, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Once again, we're offering the Premier Retirement Roadmap, no cost, no obligation, no judgment here. You can get yours today by calling 520-780-9059. It's 520-780-9059. We're also online at premret.com. Okay, Jeff, let's dive into our listener questions for this week. John's listening to us in Tucson, and John says, I'm 64 and getting married for the second time. My wife-to-be has 3 children, all grown, and I have 3 of my own. I want to set up some kind of an arrangement that will provide for my wife if I die first, but will make sure that the assets that I've accumulated over my lifetime go to my children, even if my wife wants them. What do you suggest?
Well, you can do that with a trust. If you do keep assets as sole and separate property, you may not have to commingle those anyway. If you think your new wife has enough assets, maybe just besides the house, you could do a trust for your assets and a trust for her assets. Each trust could actually be joint tenants on the house technically, or you could own the house in your trust if it's already yours, and you could put a life estate so that she could live in it until she passes away. You might also put one of your children, if you trust them to take care of your surviving spouse, that if she survives you, to give certain income enough to pay the basic bills, and maybe you can line item those out. But you can make, if you kept your assets separate in a trust and put one of your children you trust, that would take care of your wife and also keep those assets. They obviously have an interest to keep those assets intact for your family, their siblings, right? So that would probably be the simplest way that I'd suggest to do that. As soon as you start commingling assets, it's pretty much, she has a right to use pretty much everything unless you keep it separately in your name and only allow her to be a beneficiary, but not a co-owner. Once she becomes co-owner, that becomes hers when you die. So be careful about how to get around that. It's a good question. And I have several clients that had a trust before their either last spouse died or divorced, and they've still got all their assets in that trust. The new person gets a trust for their assets, and they basically have a joint account between them, or they put a certain amount of money in to pay all their bills and kind of keep things separate that way. There's a few different ways to skin that cat, but certainly worth looking at, because there are many ways to disinherit your children by a second marriage, and might not even be the spouse that you marry. It might end up being the spouse you marry and she thinks she's doing fine, and she marries a greedy guy that ends up pulling everything away from your family and her family. So you got to be careful and protect those assets. And it's a good question that you asked. Make sure you get some good estate planning advice and set up those walls around those assets so they can't be easily taken.
John, thanks for that question. And again, if you'd like to talk further with Jeff about that, 520-780-9059, 520-780-9059. Give us a call. We would love to talk to you. Next question, Jeff. Jake is in Rancho Vistosa. Jake says, I appreciate all the advice that you give on the radio. You brought me to this moment when I'll be retiring at the end of March at age 67, and I am all ready to go. So with that, I'd like to ask a question. I'll have some income in 2026, enough to reach what I believe is the $32,500 maximum for a 401k contribution. I have enough cash I put away, so I won't need that income. Can I basically put all of my 2026 income into a 401k after any mandatory reductions?
You sure can, and congratulations on retirement coming up here. Good for you. I would consider, however, the big red flag is if you're only going to make $32,500 next year, unless you're planning on taking a ton of money out of those IRAs and other accounts that you have to live on, and maybe you will, maybe you won't. But I'm guessing that to get a tax deduction on $32,000, if that's all your income next year, minus Social Security and things, you'll have a really good tax year. But it may just set you up for failure in the future, especially if that 32.5 is adding on to a few $1 million in 401k contributions and other qualified plans that are going to have to be pulled out as taxable funds later. I would not wait if you have large accounts with 7 figures or better in qualified money that hasn't been taxed, pre-tax money, that you start using them right away. You're already 67 and 6 or 7 years, you're going to have to start pulling that money out again anyway and paying tax on it. So try not to live so frugally. You probably need to start whittling away at those IRAs, either converting them to a Roth, maybe even if you're healthy, convert them to a life insurance version of a Roth, which I think is Roth on steroids. Talked about those several times. But consider ways to pay taxes on that money now, especially if next year you're going to have a very low tax bracket, probably be in the 0 to 12% bracket. I'd rather pay tax on that than let it go into a tax-free account if your employer authorizes Roths or if they also allow you to maximize your contributions. Sometimes plans are restricted somehow, not usually, but just double check the plan, check with your HR department. But there's nothing legally that says you can't put all your earned income up to the maximum allowable amount into the 401k.
Jake, thanks for joining us in Rancho Vistosa. Once again, Jeff's number 520-780-9059 if you'd like to have a further conversation. Okay, Brian's listening to us in Green Valley. Brian says, I'm 64 and 3 years away from when I want to retire. My portfolio is 100% in equities. How should my portfolio change as I approach retirement and then on through retirement?
Well, I think the biggest question you could ask, Brian, is how much can you afford to lose? You're 3 years away from retirement. You never get hurt taking a profit. Imagine the stock market crashing 50% like it did in 2008 or 2000 through 2002. Could you go through a period of time where your $1 million 401k is only worth $500,000? Could you live on other funds? Do you have enough rental income coming in that you don't have to worry about that money? If your portfolio is 100% equities, I'm guessing that means you probably don't have real estate, or you would have probably mentioned that. But I think having everything in equities is not a wise choice just from the standpoint of a financial advisor's take. Regulators would really question us if I suggested you putting all your money this close to retirement in equities. History says that that's a bad idea because the market always does correct. Now, if you are 10 years or more away and you want all of it in equities because you want the highest growth possible and you have time to wait, I have no problem with that, especially while you're dollar cost averaging into the market while you're letting it grow. But you're knocking at the door of retirement, and I think the market's knocking at the door of a big market crash. And it has been for a while. That doesn't mean it's going to happen, but it definitely looks, the times that we're in, look questionable as far as the fundamentals that drive the market compared to just history that shows us when things that are happening right now, when they've happened in the past, it's preceded pretty good market correction. I think we've got to at least be aware of that, at least respect that it could happen. And the best way to do that, in my opinion, is take as many profits off the table as you can in order to generate a guaranteed lifetime plus maybe some assets into a predictable income source. Lifetime income, predictable income, add that to your Social Security, make sure there's a buffer for inflation, make sure there's a buffer for fun stuff, and then maybe keep the rest of that 100% in equities. I don't think there's really a need for bonds in a managed portfolio unless you just need a little bit of liquidity and you just want to minimize the roller coaster, the wild ride that the stock market can dish out. But, if you had a sizable amount of your portfolio in principal protected assets that go up when the market goes up, but don't go down when the market crashes or even stays flat, you always make money in good markets, but you never lose money in bad markets. You'll find out that money that you've saved and you've done really well on, I'm sure you've done well if it's 100% in equities. Even if it's kept up with the market, maybe you beat the market because you've chosen better equities. I'm guessing if it's 401k money, you've probably just been in market correlated assets. So you've still done pretty well over the last few years. Take profits. Nothing ever hurt anybody by taking profits, and retire with confidence. If you love the market, keep investing. Swing for the fences on some of your money, but don't swing for the fences on that money you're going to use to replace your paycheck.
Brian, thanks for listening to us in Green Valley. Once again, if you'd like to have a further conversation with Jeff, it's 520-780-9059. Certainly ready to take your call, and you'll also get Jeff's book, Retirement, The Road Ahead. If you've got a question you'd like us to answer on the air, you can get it to us two ways, one of which is to call Shelley, 520-780-9059. Give it to her. She will pass it along to us. You can also go to the website, which is premret.com, premret.com, and leave your question there. If we use it on the air, of course, you'll not only get a great answer, but you'll also get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement here on 790 KNST with Jeff Hogan. Once again, we're on the air for you 4 times a week. We're also a podcast if you've missed any part of our radio program today. Jeff, before we get to what the Premier Retirement Roadmap looks like, in the last segment, you talked an awful lot about LIRPs, or you've mentioned LIRPs many times in this radio program before. Can you give us a brief overview of what a LIRP actually is? It's life insurance retirement plan, and why you favor those so much here at Premier Retirement.
Well, I don't favor them necessarily over things. I think they're a tool that we can use to enhance the net tax effect on your income plan. As far as going back to your original question, what is the retirement roadmap? It's really our process. Our process is look at the 5 pillars of planning, everything from income planning, make sure those investments either provide that income or are complementary to the income plan that you have. Make sure that we save as much as we can in taxes. That's where a LIRP or a Roth IRA would come in, as well as on the income, number one as well. After that, what are you going to do with a healthcare crisis? Is there going to be a healthcare situation where you need to go to a nursing home and have some home care because of a chronic illness, or maybe even a terminal illness? Oh, by the way, that's where the LIRP comes in as well. And then what about the legacy planning? What do you leave your heirs when all is said and done, when you haven't used all your assets, anything that's left? Do you want to give them a big IRA that has a tax consequence, or would you rather give them a Roth IRA that doesn't have a tax consequence, or even a LIRP that has no tax consequences? And if you do the LIRP right, you could even move it out of your estate and put it in a trust that doesn't have estate taxes if you're in one of those brackets where your assets are continually accumulating. Maybe you have a fairly large estate now and you're worried about getting into an estate tax bracket where almost half of your estate is given to the government just because you died rich. Well, you can move those assets out through LIRPs as well. So basically 4 out of 5 of those pillars of planning, the income planning, the investment planning. You can even consider the LIRP being an investment plan from the standpoint that it's a tax-free, it's like a tax-free annuity with principal protection. The costs involved are really the cost of insurance to play, but a mutual fund has costs, maybe 1%, 2%. ETFs even have a cost, maybe 0.5%. Jeff Bogan or an advisor has a cost, 1% or so. You're always going to be paying for the cost of whatever that product or service is, whether it's built in, whether it's charged on top. Bottom line is everything has a cost. So that aside, why a LIRP? Well, a LIRP covers so many bases. It provides tax-free income. It can be used as a systematic income where it comes in monthly, annually, quarterly, or whenever, or it can be used as just I want to tap some cash to do something fun type an account. And every time you do that, you don't go to a new tax bracket. If something happens, you get sick, you get to tap that death benefit or that LIRP, whatever the account is, you can actually borrow against it or even use it up for long-term care or even terminal illness. And again, all those assets are tax-free. Using that asset never pushes you into a new tax bracket. The only caveat to that is you have to use after-tax money. So if you want to fund a LIRP and you have everything in pre-tax money, you're going to have to dance around the tax code for a few years, but you'll never have to dance around the tax code again. You'll be able to retire in your terms, keep all the money that you make, or most of it, and pay as little as you can to the IRS, who we have learned recently, and we probably already knew, they waste our money pretty badly. They don't spend it wisely. And I would rather you keep your money in your family, keep it for your legacy, keep it in this community, in your pocket, and not send it to Washington, because I don't think they treat your money well. Neither do they mine. So tax-free, tax-advantaged, any tax-advantaged asset is a plan that I love in our Premier Retirement Roadmap. We try to incorporate it as much as we can.
So that's a life insurance retirement plan, otherwise known as the LIRP. Okay, Jeff, we invite people to call the show every week, 520-780-9059, and request their Premier Retirement Roadmap. So let's start at the beginning. When people call 520-780-9059, they request Shelley to call them back. They set up that appointment. They finally do come in. How does this appointment unfold? What's the first thing that you do with a prospective new client?
Well, basically, we just walk them in, give them something to drink, see how they're doing, and say, okay, I'm here to listen. What brought you in, and what are your goals, or how do you think we can make your life better? Typically, people will just start saying, well, these are my concerns. I don't want to run out of money. I want to know if I can retire next year like I'm planning. Or even better, I'm planning on retiring in 10 years and I wanted to get a jump on the process. Unfortunately, too many people come in right at the time that they finally decide to retire. They've been listening to the radio show for a while, watching TV programs, kind of known about this whole process for a while and just waiting for, okay, now I can finally get my 401k intact and move it around and do this plan. Well, not necessarily. It might have been smarter to start early, but bottom line, we'll take you where you are. We get some people coming in their 70s, even in their 80s. They've probably waited a little while longer than they needed to, but better late than never. What they would come in for is typically, hey, I don't want to run out of money. I don't want to risk in the market anymore. I want to make sure that I'm covered for long-term care. I don't want to pay any more than I have to for taxes. I want to make sure my investments are intact and whatever I have left goes to my heirs without probate, problems, taxes, all those things. Basically, the questions that we've been asked, or the first things that come out of people's mouths in general, are basically the reason we set up our Premier Retirement Roadmap the way we did. Basically, those 5 steps of planning, which are, okay, how are your investments doing? Any of them got you worried? Could you handle a 50% correction if we had another one? What would that do? What happens if it doesn't come back for a few years? What happens if you have an emergency and need more than your monthly income that comes from other things? Could you withstand a market correction? If they say no, then we have to work on risk assessment. And the next logical place is they'll say, okay, well, how much income do you need? Because we need to make some of these assets provide income on a guaranteed or at least a pretty predictable basis without risking your lifestyle or your sanity on risks that you can't control. So those are the main things. Can we save a lot of taxes along the way based on the strategies that we use and how we put it together? But bottom line is the first meeting, we listen for about an hour or so. We might give answers as far as how we would attack this problem. That'll be how the first visit starts. If we still are friends after the first visit and still like the direction that we're both going, then we'll have a second appointment. At that point, we'll actually put together our spreadsheet, which is really our Premier Retirement Plan, where we utilize all the tools. We make sure that we speak to the income, how the investments will be laid out. And basically, how we do this is based on what the client would tell us as their goals and based on the happy clients that we have that have those similar goals, and build a plan that we know worked for somebody over the last 20 or 30 years that came in with the same concerns as the clients that are coming in today would have. So this isn't really rocket science. It's been honed down over the last few decades. It's really just seeing to the needs of the client and utilizing all the tools in the bag that are out there. There are so many people that come in and they have this cookie cutter plan that's just a stock and bond portfolio, and they've got like 3 or 4 different accounts between IRAs and a trust account and a couple individuals, a Roth or 2. The last couple of years they've done fine, but what about the next few? I don't know. Is there any guarantee that that money's going to be there? And most of them say that their advisors don't speak to the risk element. Oh, don't worry, it'll always come back. Or, oh, keep it under 4% and your withdrawals under 4%, you should be okay. Well, should be okay. And, oh, well, it could come back. I don't think give enough warm fuzzies to most clients. And that's why they end up in my office, is because we talk on the radio about asset protection. We talk about being tactical in our investments, being in the market when we can follow the money. It looks like there's some upside. Being out of the market when it looks like we're getting crushed. 2022 is not a good year. We didn't wait too long to bail out. We probably waited too long to get back in, but I'd rather err on the side of caution and not continue to lose money. I'd rather a client get mad at me because we only made 5 or 10% instead of 20 than get mad at me because we lost 50% and we didn't get out of the market when it crashed the next time at 50%. And if you don't think the market can crash 50%, it can. It did in 2000. It did in 2008. Shoot, it did in a really quick period of time. In only a little over a month, it corrected 25% in 2018, over 30% in just a matter of a few weeks during COVID. There's nothing that says that it has to bounce back as quick as it did the last couple of times, because the Fed is getting to the point where there's really not much more money to print. I mean, what are they going to use as collateral from the banks if they've already got all their bad loans and they don't have any more assets to use as collateral? They can't just pull it out of thin air and create money. That's inflationary. That's bad for the economy. So I guess, we could save the market with the creating a worse economy, which doesn't help the market long term, just helps rich people get richer. Bottom line is, we want your assets to be protected in retirement. We want you to be comfortable in your retirement. We want your economy to be secure. We don't want to rest all of our confidence on something that we can't control. And the market is something that we can't control. It does what it does. It does it when it wants to, not based on our retirement date, based on when we pull our paychecks out, based on when we might need the money for the next big emergency. So we talk a lot about risk assessment, making sure that income's there, making sure you have a buffer for all the different contingencies that might come up. And that's really how the first appointment goes. And then we show it on a plan on the second visit. And that's when we show you all the tools that we use. And if we still like each other after that second visit, then we have a third one where you come back and ask the questions and you shoot all your questions at me like a fire hose, kind of like I did in the second visit where I told you all the different things that make sense as far as a plan. But bottom line is, when people come in, it's not just hey, we're great. You want to do business with us? Let's close the deal and go away. Just let us do our job. Some managers or some advisors kind of work that way, on more of a quick close them first and tell them what you're going to do second. We want to make sure that we lay out the whole plan and make sure you're comfortable with it before you take the first step, because we don't like undoing business or trying to re-explain things that are surprises to you. We want to make sure that it's fully understood up front, that you get how the numbers work, that you have a level of confidence that not only do you know what we're doing because of our experience and our expertise, but also that you have a confidence that the products we use work, that the strategies we use are actually approved by the IRS, not approved, but I mean, they are not out of line with any IRS codes, or they are not out of line with any norms. Just because your Wall Street guy didn't tell you about them doesn't mean they're bad. It just means that he didn't tell you about them, because that's not what they do. We do comprehensive planning, and we're going to tell you about the comprehensive plan. So it might take you a little while to get to know it and understand it, but we want to make sure you get comfortable before you move forward with this. That's really our roadmap process. And once you say, let's go, let's move forward, then you get happy and confident for the next few decades.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the Premier Retirement Roadmap and what to expect. Again, our phone number, 520-780-9059. So, Jeff, when people come in for the first visit, there's a lot of discovery there. Then you do an analysis. There's planning, implementation, and there is follow-up. But once again, I want to reiterate something that I think you talked about, and I want you to elaborate on this in the few minutes that we have left. There's really no pressure for you to sign on the dotted line, is there?
No, I mean, we're in a position, we don't need clients bad enough to be pressured. We don't have to do that. We want you to come aboard because you like what we do, not because you're coerced or somehow manipulated into it. We don't like undoing business. We have very low turnover here. People really only leave us when they die, and it's very few and far between other than that. So given that, we just don't want to complicate our life either. We have plenty of clients that enjoy our service. You know, if somebody comes by and they don't really like the direction of our plan, they want to take more risk, or they want to keep it simpler and not do the comprehensive planning that we do. Even though we keep it simple, I mean, we take care of it all. You can just delegate it all to us. We'll even coordinate tax planning, even tax preparation, even to those degrees too. If for some reason it isn't a fit, it isn't a fit. I'd rather know that after the first couple of visits than after the first year that we tried to work together and found out that it was a mistake. Because undoing businesses, it's just not worth it. But, you know, the bottom line is if you change directions, it's typically starting over someplace. I'd rather you start on the right foot that you want to start on. And if it's here, great. If it isn't, then I hope you find a place that is.
That's Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, if you'd like your Premier Retirement Roadmap, give us a call at 520-780-9059 and request that roadmap. Again, there is no cost, there is no obligation, there is no judgment. We'll meet you where you are. Well, Jeff, we're out of time for this week. Thanks so much for your time, but most importantly, I want to thank our fine listeners here in the greater Tucson area for joining us. So for Jeff Ogan, I'm Jeff Shade. Have a great December weekend. We'll talk to you next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.
If you're planning to retire soon or already in retirement, you more than likely have some questions, like when should I take Social Security? How can I avoid running out of money? Or how am I going to deal with taxes in retirement? Premier Retirement and Wealth Management can help answer these questions. They've been designing retirement plans for people like you for more than 20 years. They recognize that you're unique, so your plan is tailored to your individual needs. They'll work with you to determine what it costs to be you in retirement. Then design a cash flow plan, a tax plan, how to pay for health and long-term care plan, estate plan, and how to deal with the uncertainties of life. If you'd like to begin a conversation to answer your questions, call for your no-cost, no-obligation financial review at 520-780-9059. That's 520-780-9059. Or request it online at premret.com. That's PREMRET.com. Investment advisor services offered through Premier Wealth Advisors, LLC, an Arizona State Registered Investment Advisor.
Hi, I'm Jeff Vogan with Premier Retirement Planning and Wealth Management here in Tucson. When it comes to your financial future, you want more than just a few options. You want a full toolbox. At Premier Retirement, we're a full-service financial advisory firm with a wide range of strategies and tools to build a plan that's tailored to you. Unlike limited-scope advisors who only have a handful of products, or worse, advisors who are more focused on their commission than your goals, as a fiduciary, I put your interests first. We help you plan for retirement, manage risk, grow your wealth, and protect what you've worked so hard to build. No cookie-cutter solutions, no shortcuts, just a comprehensive plan designed for your life. If you want a partner who's fully equipped, fully committed, and fully focused on you, call me at 520-780-9059 or visit premret.com. That's PREMRET.com. At Premier Retirement, we have all the tools to help your financial plan succeed. We know it's your money, so let's keep it that way.
Investment advisory services offered through Premier Wealth Advisors, LLC, an Arizona State registered investment advisor.
Solid wealth management advice is more important today than ever. If you're unsure about your current risk level, if you haven't heard from your current financial advisor, if you feel your successful retirement is in jeopardy, call Jeff Vogan at Premier Wealth Advisors at 520-600-6363. You deserve a team by your side to help protect what you've saved. Call Jeff Vogan at Premier Wealth Advisors today at 520-600-6363. Securities offered through Premier Wealth Advisors, LLC, an Arizona State registered investment advisor.